This week is one of the biggest weeks on the stock market. We have Meta, Microsoft, Amazon, Apple, Google. The 5 biggest tech companies in the world are reporting earnings this week. And if you have been following our channel, you know that we have talked in detail about all of these companies and how we have been investing in them for years. And so on this video, we are going to talk about tech earnings and what to look for in each report, because there is a lot of opportunity to make money in the stock market if you do your research when these tech earnings come out. Hey guys, Zaman
and Christina
from Our Rich Journey.
We are going to get technical in this video because we are going to talk about how to break down the earnings reports from each of these companies. So we're going to be talking about revenue, net income, EPS, guidance. But not only that, we're going to be talking about trends, because how these reports come out and what is in these reports is really going to indicate whether these companies are going to be good investments moving forward.
You see, what I love about this is that when earnings reports come out, it's not just about the numbers, what they have done for the year or for the quarter. It's about the trends, how these companies are moving forward. Because when you invest in a company, the thing that you are looking for is potential. Are profits going up? Are costs going up? Are they investing more in research and development? Because investors will react more to what the future has planned for these companies. So if a company beats expectations and shows strong future growth, their stock price usually jumps. If they miss earnings and warn of a slower pace of growth or negative growth, usually that stock gets hammered.
So as these 5 tech giants release earnings this week, here's what you should be watching. And we're going to start with Microsoft. Now, Microsoft stock is trading at around $524 a share with a market cap just under $4 trillion. In their last earnings, they reported $76 billion in revenue and $27 billion in profit, a massive margin. Their earnings per share came in at $3.65 versus the expected $3.38, a solid beat of 27 cents. Now, total revenue grew about 15% over last year, and net income rose to more than $100 billion. That kind of growth from a company of this size is incredible. And it all comes back to Azure, Microsoft's cloud business, which continues to be the engine behind these results. So that's where Microsoft stands right now. Strong growth, huge profits, and a business firing on all cylinders. But going into this next earnings report, here's what you should be watching closely. First, Azure growth. Cloud continues to be Microsoft's main profit engine. Last year, Azure grew around 25%, so investors will want to see if that momentum continues or starts to slow. Second, AI integration. Microsoft has been weaving AI into everything, from Copilot in Office 365 to AI tools in Windows and its developer platforms. Watch for how much AI adoption is driving enterprise spending and whether they're seeing meaningful revenue from it. Third, margins. Microsoft has managed to grow revenue without letting costs rise too fast, a sign of strong management. If their operating margins hold steady or even improve, that's a big positive. And finally, guidance. Investors will want to see what Microsoft says about 2026. Are businesses still spending on cloud and AI, or are they starting to pull back? That guidance will set the tone for tech stocks overall this quarter. Next, we have Meta. Meta's stock is trading at around $738 a share with a market cap of about $1.83 trillion. In their last earnings, Meta reported $47.5 billion in revenue and $18.3 billion in profit, continuing their impressive comeback story. Their earnings per share came in at $7.14, beating expectations of $5.86, which is a huge $1.28 beat. Now, over the past year, Meta's revenue has jumped from $164 billion to $178 billion, and net income has nearly doubled to over $71 billion. Their profit margins remain extremely strong, showing that even with massive investments in AI and the metaverse, Meta's core business, digital advertising, is thriving. So that's where Meta stands right now. Incredible profitability, strong ad demand, and a CEO who's managed to cut costs while doubling down on innovation. But going into next earnings reports, here's what you should be watching closely. First, advertising revenue. ads still make up the bulk of Meta's income. Investors will be looking to see if ad growth is still accelerating across Facebook, Instagram, and Reels, especially heading into the holiday season. Second, AI investment. Meta's been pouring billions into AI infrastructure to improve content recommendations and advertising efficiency. The question now is, are those investments translating into measurable revenue growth or just higher expenses? Third, Reality Labs spending. The Metaverse division continues to lose billions. Watch whether Meta's losses there are narrowing or if the company signals more heavy spending ahead. And finally, user engagement. Daily active users across Facebook, Instagram, and WhatsApp will be key. If engagement is rising, it strengthens the ad story. If it stalls, that could raise questions about how much growth is left in the core platforms. So these are all indicators that will tell investors whether Meta can keep balancing innovation with profitability, or if the costs of AI and virtual reality begin to weigh on the story. Next up is Google or Alphabet. Now, Alphabet is trading around $260 a share with a market cap close to $3 trillion. In their most recent quarter, Alphabet reported $96.4 billion in revenue and $28.2 billion in profit, with earnings per share of $2.31, beating expectations of $2.20 by 11 cents. Now, over the past year, revenue has climbed from $350 billion to $371 billion, and net income rose from about $100 billion to $115 billion. Their profit margins remain strong, showing how resilient Alphabet's core ad and cloud businesses continue to be despite tighter marketing budgets across industries. So right now, Alphabet's in solid shape: consistent growth, rising profitability, and a dominant position in online search and advertising. But heading into next earnings reports, you should be focused on a few key areas. First, ad sales. Advertising is still Alphabet's main revenue driver, so keep an eye on how YouTube, search, and Google ads perform, especially whether YouTube ad growth continues to accelerate after several strong quarters. Second, Google Cloud. This segment has become one of Alphabet's fastest growing businesses, contributing a growing share of total profit. Investors will want to see if cloud revenue growth stays above 20% and whether margins are improving as the division scales. Third, AI integration. Alphabet has been embedding AI across search, workplace, and YouTube. So look for updates on how search generative experience and AI tools for advertising are impacting engagement and monetization. And finally, costs and buybacks. Alphabet has been managing expenses carefully while continuing share repurchases. If operating costs rise sharply or if buyback activity slows, that could signal a more cautious outlook. So these updates will give investors a clear picture of how well Alphabet is balancing heavy AI investment with continued profitability and whether it can keep its edge in an increasingly competitive tech landscape. Next is Amazon. Now, Amazon stock is trading for around $224 a share with a market cap of about $2.4 trillion. In the last quarter, Amazon reported $158.9 billion in revenue and $15.3 billion in profit, with earnings per share of $1.68, beating out expectations of $1.32 by 36 cents. Now, over the past year, Amazon's revenue has grown from $637 billion to $670 billion, while net income has surged from $59 billion to more than $70 billion, a huge turnaround from just a few years ago when profits were tightening. The company's efficiency drive and cloud strength have clearly paid off. So right now, Amazon's business looks balanced across its three pillars: retail, cloud, and advertising, each fueling growth in different ways. But going into next earnings reports, this is what you should focus on. First, AWS, or Amazon's Web Services. Cloud remains Amazon's most profitable segment, and last quarter, AWS growth accelerated again. So watch for whether cloud revenue can stay above 20% growth and if operating margins continue to expand, a key sign that AI-related demand is boosting performance. Second, advertising. Amazon's ad business has quietly become a powerhouse, generating billions in high-margin revenue. Investors will want to see continued double-digit ad growth, especially heading into the holiday season. Third, operating efficiency. Under CEO Andy Jassy, Amazon has focused heavily on cost discipline, particularly in logistics and fulfillment. So look for improvements in operating income and margin expansion as the company streamlines delivery and automation. And finally, consumer demand. With interest rates still high and global spending uneven, Amazon's retail results will offer clues about overall consumer health. Rising e-commerce sales or strong Prime membership growth would signal that Amazon's ecosystem remains resilient. And altogether, these updates will show how Amazon is balancing short-term profitability with long-term investment in AI and logistics, two areas driving its next phase of growth. And finally, we have Apple. Apple stock is trading around $263 a share with a market cap of roughly $3.9 trillion, making it the most valuable company in the world. In its latest quarter, Apple reported $94 billion in revenue and $23.4 billion in profit, with earnings per share of $1.57, beating expectations of $1.43 by 14 cents. Now, over the past year, Apple's total revenue has climbed from $391 billion to $408 billion, while net income has risen from $93.7 billion to $99.3 billion. Even at this massive scale, Apple continues to grow both sales and profits, showing just how strong its global ecosystem remains. Heading into this next earnings report, you should pay close attention to these areas. First, iPhone sales. The iPhone remains Apple's largest revenue driver, and performance here often sets the tone for the entire quarter. For this report, investors will be watching for early indicators of iPhone 17 demand, especially in key markets like China and India, and how it's performing compared to last year's iPhone 16 launch. Second, services. This category, which includes iCloud, Apple Music, and the App Store, continue to grow faster than hardware. Investors want to see if Apple can maintain double-digit growth in services and expand margins as more users move deeper into the Apple ecosystem. Third, wearables and AI. Products like the Apple Watch, AirPods, and Vision Pro are crucial to Apple's push beyond the iPhone. Any commentary on integrating AI across devices, particularly within Siri or Apple Intelligence, could drive future growth expectations. And finally, margins and buybacks. Apple is known for its incredible efficiency. Watch for gross margins staying above 45% and whether the company continues its aggressive share repurchase program, both key indicators of management confidence. So these results will reveal whether Apple can keep expanding beyond its hardware roots while maintaining the record-breaking profitability that's defined it for over a decade.
So that's what we look for. You see, each one of these companies gives us a clue about where the economy is going because they make up so much of the economy and so much of the stock market. These reports answer questions about consumer demand, business spending, advertising strength, and innovation trends. And so when these 5 companies move, the entire stock market reacts. Now, with your limited dollars, how do you go about picking which one of these individual stocks to put your money into? I mean, we're not all flush with cash and can just put a bunch of money into all of these individual stocks. So you have to make a decision. You have to prioritize. But there is an alternative, and that is why we love ETFs. And so if you want to invest in tech companies, you should be considering a tech ETF like VGT. We have talked about VGT a number of times on this channel. And if you have been investing along with us, you have done really well investing in VGT.
Now, keep in mind, VGT is Vanguard's information technology ETF. It owns the top tech companies, so companies like Apple, Microsoft, NVIDIA. It's all in one fund. And the performance, the historical performance of VGT has been amazing. So the total return for VGT over the past 12 months is 27.9%, and it's already up 20.5% just this year. And over the past 10 years, its average annual return has been 23.45%.
23.45%. Now see, that is what builds generational wealth. That's what builds real wealth. Not this picking and choosing every stock. Why work harder? You should be working smarter. And when you invest in an ETF, you are doing exactly just that. You are capturing it all. And so when you invest in VGT, if history is any indication of future performance, then you can see the results speak for themselves. And so, like we said, we've talked about our investments before in the past. On this channel, we've talked about some of them, but we haven't shared all of them. But if you are in our 365 Days to FIRE program, you have seen our entire investment portfolio. You have seen the individual stocks that we invest in, the ETFs, the index funds, you have seen it all. And if you are one of our students and have taken action on the information, you are doing very well.
That's right. So many of our students have reached financial independence and retire early. If you are interested in seeing our full investment portfolio, learning more about investing, and going through the entire program that helps you build your FIRE plan, then you have to check out our 365 Days to FIRE program. You can find out more information about it at 365daystofire.com. We will also leave a link in the description below. So now that you have all of the information that we covered in this video, it's up to you to go out and take action. Do your research, find out what investments work best for your investment style and your portfolio. And of course, if you like this video, make sure to give us a thumbs up, subscribe to our channel, and join the journey.